Throughout history, economies have risen, collapsed, and rebuilt themselves in cycles of prosperity and decline. Some downturns are minor corrections, forgotten within a few years. Others, however, have reshaped the very fabric of nations, altered global power balances, and left permanent marks on societies. These are the world-changing economic crises, the Great Depressions, recessions, and financial collapses that redefined how humans trade, work, and live. We will trace the most significant crises, understand their causes, and analyze their long-term consequences. The Great Depression of 1929. The Great Depression of 1929 stands as the most devastating economic collapse in modern history, not only because of the sheer scale of financial loss, but also because of the profound social, political, and cultural transformations it triggered across the globe. It began in the United States, but like a contagion, it spread quickly to Europe, Latin America, Asia, and Africa, leaving virtually no nation untouched. At its core, the crisis was rooted in several interconnected problems. The 1920s, often called the Roaring Twenties, were a period of booming prosperity in America. Stock markets rose dramatically, fueled by optimism, technological innovation, and rapid industrial expansion. However, much of this growth was built on fragile foundations. Investors speculated recklessly, buying stocks on margin, meaning they borrowed money to purchase shares, assuming that prices would always rise. Banks, largely unregulated, extended risky loans and tied their fortunes directly to the volatile stock market. Agriculture, meanwhile, was already suffering due to falling crop prices and overproduction, leaving millions of farmers vulnerable. When the Wall Street crash struck in October 1929, confidence evaporated almost overnight. Stock prices collapsed, wiping out billions of dollars in paper wealth. Banks that had lent money for speculative purposes suddenly faced mass defaults. As panic spread, depositors rushed to withdraw savings, causing a wave of bank failures. Without functioning banks, credit dried up, and businesses could no longer borrow to maintain operations or pay workers. The economic fallout was catastrophic. Factories closed, industries contracted, and unemployment soared to unprecedented levels. In the United States, unemployment reached nearly 25% by 1933, and in countries like Germany, it climbed even higher. Families lost homes and farms, while many were forced to survive on government relief or charity. Breadlines and soup kitchens became everyday realities, symbolizing the despair of ordinary people. The psychological toll was equally severe. Suicides rose, birth rates declined, and faith in the future dimmed. But the Great Depression was not confined to America. Because the U.S. was the world's largest creditor after World War I, its collapse rippled outward. European economies, already weakened by war debts and reparations, suffered deep contractions. In Latin America, demand for exports like coffee, sugar, and minerals fell sharply, plunging countries into crisis. In Asia, colonial economies dependent on trade saw massive unemployment and poverty. The political consequences were equally far-reaching. In Germany, economic despair fueled public anger and created fertile ground for extremist ideologies. The Nazi Party exploited this discontent, eventually rising to power under Adolf Hitler. In other nations, too, the Depression led to instability, protests, and a loss of faith in liberal democracy. The link between economic collapse and the outbreak of World War II cannot be ignored. In the United States, the government eventually responded with bold measures under President Franklin D. Roosevelt's New Deal. This program marked a turning point in economic thought by recognizing that governments had both the power and the responsibility to intervene in markets. Massive public works programs provided jobs, while reforms regulated banks, introduced deposit insurance, and created social safety nets like Social Security. These policies did not end the Depression overnight. but they stabilized society and laid the foundation for a more resilient economy. The Great Depression changed the world's understanding of capitalism forever. It revealed the dangers of unchecked speculation, inadequate regulation, and overconfidence in markets. It also showed that economic crises are not purely financial. They carry profound social and political consequences that can reshape entire civilizations. The legacy of the Depression still influences economic policy today, reminding leaders of the catastrophic consequences that can arise when systems fail to protect their most vulnerable citizens. The oil crisis of 1973. Fast forward to the 1970s, when the world faced a very different kind of crisis, one rooted not in finance, but in energy. In October 1973, following the Yom Kippur War, the Organization of Arab Petroleum Exporting Countries, OPEC, imposed an oil embargo on nations supporting Israel, including the United States and much of Western Europe. Suddenly, oil prices quadrupled, sending shockwaves across global economies. For ordinary people, this meant gas shortages, long lines at fuel stations, and soaring transportation costs. For industries, it meant higher production costs and inflation. The crisis exposed the world's deep dependence on Middle Eastern oil and reshaped geopolitics. Western governments scrambled to find alternative energy sources, invest in nuclear power, and strengthen relations with oil-producing nations. The oil crisis highlighted how vulnerable the modern economy was to resource shocks. It accelerated efforts toward energy efficiency and reshaped foreign policy strategies, making oil a central factor in international relations. It also triggered a period of stagflation, simultaneous stagnation and inflation that challenged economists and policymakers alike. The Asian financial crisis of 1997. In the late 20th century, globalization had created new centers of economic power. Southeast Asia, known as the Asian Tigers, experienced rapid growth fueled by foreign investment, export-led strategies, and booming financial markets. However, in 1997, cracks appeared in this miracle. The crisis began in Thailand when the government was forced to abandon its fixed exchange rate, causing the Thai baht to collapse. Panic spread quickly, with currencies and stock markets in Indonesia, South Korea, and Malaysia plunging as investors fled. The IMF intervened with massive bailout packages, but not without controversy. For millions of people in Asia, the crisis meant mass layoffs, bankruptcies, and widespread poverty. The middle class, which had only just begun to emerge, was pushed back into hardship. Politically, it fueled unrest, most dramatically in Indonesia, where President Suharto's 31-year rule came to an end. The Asian financial crisis reshaped the region's economic policies. Nations began accumulating foreign exchange reserves as a defense against future shocks. Regulations on capital flows were tightened, and leaders became wary of overdependence on short-term foreign capital. The crisis also revealed the dangers of unregulated globalization, an issue that would resurface a decade later. The global financial crisis of 2008. Perhaps the most familiar crisis to our modern memory is the 2008 global financial crisis, the worst economic collapse since the Great Depression. Born out of reckless lending practices, complex financial derivatives, and a housing bubble in the United States, it spiraled into a global disaster. Banks had issued risky subprime mortgages to borrowers who could not afford them, bundling these loans into securities sold worldwide. When homeowners began defaulting, the financial system unraveled. Major banks like Lehman Brothers collapsed, while others required unprecedented government bailouts. Stock markets crashed, credit markets froze, and international trade slowed dramatically. For ordinary citizens, the crisis translated into foreclosures, job losses, and shattered savings. Unemployment surged, especially in the US and Europe. Trust in banks, corporations, and governments eroded. Protest movements like Occupy Wall Street emerged, demanding accountability and fairness. Governments responded with massive stimulus packages, bailouts, and monetary easing. Central banks slashed interest rates to near zero, while trillions were injected into economies. Regulations such as the Dodd-Frank Act in the U.S. sought to curb risky banking practices. Yet the crisis left behind deep scars. Rising inequality, populist movements, and skepticism toward globalization and capitalism itself. The COVID-19 recession of 2020. The most recent world-changing economic crisis arrived not through finance or oil, but through a virus. The COVID-19 pandemic of 2020 brought global economies to a halt. Lockdowns shut businesses, grounded flights, and disrupted supply chains. Within weeks, stock markets crashed, oil prices briefly turned negative, and millions lost jobs. Unlike past crises, this one combined health and economic dimensions. Governments were forced to balance saving lives with saving livelihoods. Trillions were spent on stimulus checks, wage subsidies, and emergency healthcare measures. Central banks unleashed unprecedented monetary support. The effects were uneven. While millions fell into poverty, certain sectors like technology, e-commerce, and pharmaceuticals experienced massive growth. Inequality widened, both within nations and between them. Developing countries struggled with debt, while wealthier nations secured vaccines and recovered faster. If you found this explanation helpful, make sure to subscribe for more deep dives into history and economics.